Hello, my name is Karen Daly, and welcome back to the Daily Discussion. I am the attorney over at EKKO Title Ashburn 1 Loudoun office, and with me today I have Marcus Simon, the attorney at our McLean branch, and Todd Condron, who is the attorney at our Vienna branch. Today, we are going to be talking about assumable loans. This is a follow-up to our earlier video talking about assumable loans, and today we are going to really talk about what to expect as you go through an assumable loan transaction. So with that being said, Marcus, what are assumable loans?
Yeah, so normally what happens when you go to buy a house and sell a house is the seller has to pay off their mortgage, right? I'm selling my house, I've got to pay off my mortgage. They do that by having the buyer who's going to buy the house take out their own mortgage. You use the buyer's lender's money, right? Comes to the escrow company. Yeah. We send out a check to pay off the seller's lender, and that takes care of the mortgage. With an assumption, you say, that seems like a lot of extra effort and too many steps. How about I just take over your mortgage payments for you? So you keep your mortgage in place, I'll just step into your shoes and I'll take over your payments. Now your house has gotten up in value, so I'll make up the difference between whatever your loan balance is and what we think what we can agree the value of the house is by paying cash or some other form of financing. But let's save a few steps and take over your mortgage payments. And I want to do that because right now interest rates are really high, right. But when you took your loan out a few years ago, interest rates were much lower. So it can work to everybody's advantage.
So what are some reasons why a buyer would want to do an assumable loan?
Well, it starts with simple math, right? I mean, if you right now are going to get a pre-approval letter to buy a property at 7%, and you go to a listing with a seller who's advertising that you can assume their loan at 2.5 or 2.75%, which with some of the VA loans over the past couple of years have been down that low, 3% even, then as a buyer, I mean, you have to jump at that, right? So ultimately it can save you $800 to $1,000 a month in your mortgage payments just to go that route as opposed to underwriting on a conventional loan.
And what about time of the mortgage too? Would there be a benefit for that?
Time in terms of the process itself?
As far as the length of the loan, right? If you're assuming a mortgage, does that mean that it's 30 years or is it less because you're assuming?
Yeah, you jump right into the seller's shoes. So if they took out the loan 2 years ago, instead of a 30-year lock, you're looking at 28 years until you pay off the loan. So in terms of the amortization, the payments are the same, but yeah, you're right. I mean, you're paying the loan off earlier than otherwise you would.
And Marcus, are all loans eligible for assumption?
Well, so this is one of the things. If you're a listing agent and you're watching this video thinking, hey, how can I seek out some VA borrowers or who do I seek out, right? If I want to try and market a house as an assumable loan. And so the first thing you need to find out from a seller or somebody who says, hey, I got a great rate when I bought this house 3 years ago. Do you think we could use that to my advantage to make my house more attractive and sell it quicker? First question is going to be, well, what kind of a loan do you have, right? Let's find out if it's even eligible for assumption. Most conventional loans are not assumable, right? You get a better rate, it's a more streamlined process, but as far as the lender is concerned, that deal was unique for you, right? We picked you, we underwrote you guys may remember a lot of the paperwork you had to fill out, and this loan's for you. And by the way, I know it's a 30-year loan, but we figured you probably were gonna sell it before 30 years were up. And so we assume a certain amount of churn in these loans to make our money back, so we're not lending this money out for free forever. The government-backed loans are a little bit different, right? Their incentives are a little different. They're fine with carrying that rate for 30 years. And so by default, almost every Veterans Administration or VA loan is going to be assumable with certain conditions, right? Provided that you've been current on your payments and you meet all the right criteria. A lot of FHA loans are also assumable. There's a small category of conventional loans that may qualify if you had an adjustable rate mortgage and you finished your fixed period and now you're just floating with the market. Those might not necessarily be great candidates though, because you're floating with the market, and so that rate may not be as attractive as the government-backed loan.
Okay. Now, Todd, let's talk about buyers and buyer expectations. If you have a buyer and they see this house and it's been marketed as, hey, this has an assumable loan, what are buyer expectations that need to be dealt with right up at the beginning?
Yeah, and one right off the bat I can say is that a buyer's agent needs to be on the lookout for the assumption. And what I mean by that is I closed one recently and I was talking to the buyer's agent about it. And the funny anecdote that she left with me was that she didn't even know that it wasn't advertised as an assumption, and where it was buried in the MLS in the comments way down below, basically fluff language, as they call it, about the property. She missed it, her buyers missed it. And it wasn't until the buyer's father happened to be looking at the listing that he said, hey, by the way, you've been approved at 5.5 and there's an assumption at 2.75 on this property. Did you know that? So number one, just know to look out for it in listings. And that's, I guess, where you're gonna be able to find it nowadays is in the MLS. So that's number one, just being able to find out if the property has an assumable loan. So that's number one. Now, expectations. This market is reminding me a lot of 2007 in the short sale market in one specific sense. And that is that back then, the lenders were a little bit unprepared for what came. And I think it was a little bit foreseeable, but nevertheless, when we started doing short sale workouts with large lenders, they were unprepared for the wave of them that hit. And so they took a lot of time to get through. And I'm seeing a little bit of that with the one that I recently closed. For example, we ratified on August 24, we closed October 31. So you're talking about more than a 60-day process. And as a buyer, we've gotten a little bit used to, a little bit spoiled in our market. 30-day close isn't even in vogue anymore. It's usually 17 to 20 days, and that's not going to happen with an assumption. Be patient. Number one. Number two is that the buyer's agent, oddly enough, in our particular assumption closing, could not communicate directly with the seller's lending company. So only the buyers could. They were going through an application process with the seller's lender for the loan they were assuming. And usually a buyer's agent has direct access to a loan officer. They've chosen the person most of the time. And that's not the case here. And so there has to be another expectation. Unfortunately for buyer's agents, you might not even be able to talk to the underwriters for the loan that's being assumed, which can be frustrating.
Do you think that a seller could give the authorization to the lender to talk with the buyer's agent?
I think that's something that's going to get worked out because I can't see it continuing like that.
And Marcus, with the seller, when they are telling their listing agent, hey, I have an assumable loan, right? What can a seller do to prepare so that way when they get a buyer who says, yes, I want to assume your loan, they can go ahead and just roll right on into the process?
Yeah, a couple of things from the listing agent's perspective, right? And Todd makes a really good point. You need to think about how to use the MLS. So a lot of agents are just putting it in the comments, which is a hard place to find. It's not a searchable field. There actually are fields in the MLS, I've learned, where you can specify what kind of financing you'll entertain. You can actually put in, VA, let's talk about VA for a second, but it's VA assumable or it's assumable with a substitution, meaning like if you have another VA certificate holder or eligibility holder, then we'll do an assumption for them. You can make it fully assumable, but there are fields in the MLS where you can put it that become searchable, and then on buyer's agents, they need to add those fields to their search criteria, right? So you can't just search on bedrooms, school district, and whatever. If you're looking for assumables, you can do that, but that's probably a different video for another day. But learn how to use the MLS as a listing agent to make that a searchable field and something that people can find easily. That's the sort of corollary of what Todd was saying about buyer's agents. Then the other thing is to prepare is go ahead in advance, reach out to your lender and let them know that you're going to market the house for an assumption, ask for what their sort of standard assumability package or their assumption package. There's generally going to be some sort of authorization, just like we had in short sales, as Todd was saying, and see if we can't work with the lender to authorize multiple parties, right? So can I get authorized buyers? And they obviously need to be authorized because they're going to have to be underwritten. But if there are other people you can add, the title company, we ought to be able, because again, with some of these, and we're going to get this in a second, we're talking about allocating the costs. A lot of the lenders don't know yet what they're doing, right? And they don't know what they're going to need. But typically with contrasting mortgage types, typically with a conventional mortgage, we get instructions from the lender about how to handle escrows. Right. With an assumption, it's reversed. We got to tell the lender, hey, this is because we're in charge of paying the taxes and paying the new homeowners insurance and stuff like that. So we actually, they've waited for us to send them a settlement statement to show them what the escrow exchange or proration is going to look like, right? So, but start the process early. Make sure that the buyer's agent, the buyer, your listing agent, so you, your seller, and the title company, the title attorney you think you're going to work with, all are going to have authorization to communicate with the bank. Because one of the hard times just to settle up the escrow account was the bank didn't want to tell us, right? Oh, yeah, we know what it is, but we can't tell you. Like, well, how are we supposed to get this deal done if you won't tell us? So those are the things that you start early, get them working on it, find somebody. If you can find somebody who knows what they're doing at the bank, write their extension down. Because again, it's just like short sales. Finding somebody who's got some experience with this. You aren't gonna find anybody who has experience with it, but finding somebody who's competent is gonna be really key too.
So with assumptions, one of the questions that comes up too is liability, right? Because the seller's loan is being assumed. So is the seller still on the hook for potential default if that happens? Or how does the seller get released from that?
Right, so one of the things to look at, and again, or have an attorney look at when you get this assumption package, is what is the deal exactly? Because one of the pitfalls would be, is the seller fully released? Because assumption just means, that, like I said earlier at the very beginning, all an assumption means is I'm going to step into your shoes and start making your payments, right? And banks say, sure, you want to have somebody else make payments? That's great. But what you also want as a seller, since you're giving up the property, is you also want to relieve of your obligation to pay it back. So you want a release of liability. So like a full substitution, right? Substitution is a little bit different than just assumption. Also, I think we probably will start seeing some scams, or I say scams, but some shady kind of deals where people are offering us, what they're calling assumptions. We saw this with short sales too, that aren't truly assumptions. So make sure you read the fine print, make sure you know you're getting released fully from liability, and then make sure and then the problem we've got though is that if the contract just says assumption, right? So the contract says it's an assumable loan. As a seller, don't you want a contingency that says, well, just like with short sales, assuming it's approved within a timely fashion, we can meet our settlement date, and I'm fully released from liability. And if we can't get all three of those things, then I want the right to void the contract and back out of the deal. So those are some things to watch out for.
Is another document that could be potentially of help in determining escrow allocation the mortgage statement?
Yeah, that's right. So you're going to grab things. This is like you're a great lawyer, like giving me leading questions, right? Here's a leading question for you. But yeah, so in addition to that package, if we're having a hard time communicating with the assumption lender about escrow balances and things like that, start saving your mortgage statements, right? Because that'll have your escrow balance on it. That'll at least give us a pretty good ballpark place to start. And then the other thing you're gonna have to think about as this goes from month to month to month is what is the loan balance gonna be at the end of the day, right? Because the way you write up the sales contract on page 1, you fill in a down payment and then an assumption amount. But that's fluid, right? Every time you make a mortgage payment, the balance goes down a little bit, the escrow is going to go up a little bit, and it's going to change all the numbers every time you make a payment.
So do you think perhaps also having the amortization schedule that you got at closing, would that be helpful?
I don't think so. Actually, I think that's a little too much because that doesn't account. If you make an extra payment of principal one time because you get a good year, right? And now your amortization schedule is off. So you really need to get that info from the lender, but you need to build in some flexibility in everybody's mind about, well, what happens if these numbers are not exactly what we thought they were going to be. And Todd probably can tell us how he's dealt with that.
Yeah, from a nuts and bolts perspective, one thing I can say that I want to be clear about is the settlement agent needs to be driving the boat. What I mean by that is in our transaction, the number one question was, what is that assumable balance? And no one seemed to know. There were some mitigating circumstances with our seller who was having some health issues. So the communication there wasn't so great. But what we were able to do, on a standard deal, what do? We order a payoff, right, of the seller's mortgage. And so we just kept reordering a payoff. And so what that would tell us is, here's the principal balance. Here's the escrow amount, which was listed on there. Here's the per diem. And that left it up to us to kind of figure out what those numbers were. And quite frankly, I got to tell you, about 3 to 4 weeks in, I contacted our underwriter with the loan company, and she was wonderful to talk to. And I said, look, I got to ask you, are you seeing this a lot? Because I'm assuming that there's going to be a lot of these coming. And she told me she was absolutely overwhelmed. And she said that, because the one question everyone wants to know is timeline. When are we going to get approved? When can we close? And that's why I was calling And she said, frankly, I don't know.
Marcus, getting back to the contract, because we're talking about some of these issues, is there some language that you have or that you can recommend that would address this situation?
Right. So I mean, one of the things we talked about with the contract is, so when you're picking your financing type, right, if you check conventional and then it says addendum attached, right? You check FHA, addendum attached, VA, addendum attached. You check assumption, it's just assumption, right? And so there is no standard board-approved assumption contingency. So right now, if you're doing an assumption, I would recommend, I mean, it's most of our cases, everybody's sort of figuring it out. And so I'm sure Todd did what I've had to do, which is we'll just extend it again, we'll extend it again. Everybody wants the deal to work.
Right.
But technically, somebody's in default every time that settlement date comes and goes. So you really need to have an addendum. I suspect if these catch on as we think they are, as we're seeing, as the lenders are seeing it,
right,
you will get something. But until then, you talk to one of us, talk to somebody at EKKO who's done a bunch of these. It's because a couple of things you're going to want. You're going to want a settlement date, a flexible settlement date, right? Just like with short sales. You can either say, we'll settle 7 days after receiving assumption approval, or we'll have a settlement date of X, because sometimes you want to give the lender a deadline. Like, hey, guys, we've got a closing in 30 days,
right,
but then know for ourselves, settlement may be extended by up to so many days to attain, assumption approval. So first, just that flexible settlement date. Again, you want to make it contingent probably on the seller getting what they want as far as a release of liability. And speaking of settlement date, one other thing that's a little counterintuitive, because assumptions, almost everything's like being an upside down world in a little ways, that we're the loan closer, we're giving them the numbers, not the other way around. Settling at the end of the month seems like a smart thing to do with a regular loan, because you're minimizing the amount of prepaid interest, and then you get a long period of time before you have a payment due. But with the assumption, because mortgage interest is paid in arrears, if you settle on October 31st, you now have to charge the seller 31 days worth of interest, 30 days worth of interest, because they have to pay for all of October, because the buyer needs to make a payment to the mortgage company the next day, November 1st, that November 1 payment. They're assuming that payment. That payment is to pay for the value of the money during the month of October. So you have a big chunk of unexpected, payoff, because the seller, I didn't have to pay anything off. Well, actually, you have, a couple $1,000 you got to pay off. And then also the buyer's like, wait, I just came up with all this money,
right,
and now tomorrow I got to write a mortgage payment. So I would think if you can control it, settling the second or third day of the month, that's a problem too, right? Because now you've made a mortgage payment on the first, but it hasn't cleared, so you don't know what the balance is. So probably like maybe about 10 days in, if you can do it. But the middle of the month is probably gonna be a little bit better. It'll ease the amount of prorated interest that you have to deal with. It gives the buyer a little bit of breathing room before they have to make that next regular payment. And the numbers will work out a little more evenly. So bottom line is, talk to us about you're targeting a settlement date, and the end of the month is going to have its own set of issues. Too close to the beginning of the month may have a set of issues too. So come talk to us about setting that settlement date. We can help you guys figure out the most optimal time to do it.
And also, I think one of the other things to talk about as far as a surprise to the buyer, or maybe it's not, it might be a good surprise, is the closing costs, right? So we hear a lot, especially with VA loans, right? We see that there's funding fees and extra costs because of a VA loan. What can a buyer expect as far as closing costs in an assumption scenario?
So right now, lenders may figure this out, but right now they charge a funding, or they charge a assumption fee, right? Which is under $1,000 typically, $500-600.
Okay.
If it's VA, there's going to be a VA funding fee, and all in, you're talking about maybe $2,000 for a roughly $500,000 loan, right? Anywhere in that range. And then the other big savings you get is you don't have to pay transfer taxes again, right? So when you take out a regular mortgage, you pay $3.33 per thousand. Right. So on $1 million loan, $3,333, right? So it gets expensive because those taxes have already been paid, right? When the mortgage was originally taken out,
right.
They may figure this out. The government may figure out how to tax these too. Sure. But hey, those taxes were already paid when that was first recorded. All I'm doing is just stepping in and taking over the payments. So there are no recording taxes. There's a recording fee of like $26 to record the document, but there's no recording taxes. So essentially your recordation taxes are cut mostly in half. Because you only have to pay recording taxes on the deed. And then you don't have an appraisal fee typically, because the bank's they're already on the hook. The property's already been evaluated. The new thing they're doing is deciding whether you as a person can afford to make these payments or not. So they're underwriting you, but they're not re-underwriting the property again. So the actual closing costs can be less. Figuring out what exactly is going to be on the settlement statement can be tricky. Again, how much money is in that escrow balance? When was the last time we paid taxes? When are they due again?
Right.
Yes, there can be some big fluctuations in what is that last check that I have to bring to the title company going to look like.
Right.
That can change by thousands of dollars, depending on when is that next payment due and so forth. So there's a little bit of uncertainty there, but those are prepaids, right? That's money that's going to have to be paid to somebody eventually. The actual overall costs can be considerably less than taking out a regular mortgage.
That's really good to hear. But in talking about costs too, one of the things I think that is coming to light is I'm assuming this loan, but my sales price is higher than the mortgage balance. So what are some ways that a buyer can come up with or look into as far as handling that gap?
Yeah, so there, again, this is part of the math involved is you have an assumption balance. Let's just say it's $400,000 and our contract sales price is $600,000. So you're assuming that $400,000 loan with you're credited that at settlement. How are you going to bridge that $200,000 gap? Obviously, A is cash. If you have the money, then you can do it. And I think for listing agents, a good tip, if you are doing an assumption type of listing, is to make sure you're checking that the buyer does. But there is a second option, which would be a home equity line of credit. That would, in essence, be a second loan attached to the title of this property, junior to the loan being assumed. And in the one that I closed recently, we didn't go that route. So the buyer had the cash to bridge that gap, so to speak. And I think you're going to see in our market here in Northern Virginia for a while that a lot of these VA loans that were given 100% financing on prices that have been bid up over the hot market that we've had, quite frankly, the gaps are going to be pretty slim. And I think by and large, the buyers are going to have that money to bridge that gap, so to speak. But there is the ability to get secondary financing. There are limitations on that. The loan being assumed will have to approve it. And that is a hurdle that you need to get through right at the beginning because there are stipulations there. I think Marcus mentioned earlier that a loan, the second loan would have to be assumable as well. So I think it's a good idea for a buyer if you're cash strapped and if you are going to be buying a property as an assumption that you have those conversations ahead of offer time. You have them far ahead of even searching for a property with a lender who's willing to do the secondary financing, what the qualifications for that will be. Can you get a pre-qual letter? Is it assumable? So you're gonna have to figure all of this out before even hunting for the new home.
So I think, to sum up, after listening to you two talk, ultimately the best advice to give to agents is ratify the contract and send it to EKKO.
There you go.
Right?
And even before you ratified, right? Like say yes to everything, and we can say yeah. We can figure out the details. We can help you, right? We can help you get the contract words right. And one other thing on the financing is look at this as an opportunity, right? I know this is a tight market and volume seems down, but as Todd was saying, the gaps, the funding gaps would be relatively small. So be open to being creative, right? Maybe if it's only $50,000, $60,000, maybe sellers willing to do a take back, right? Maybe mom and dad, they may not want to provide down payment assistance, but they may be able to do a family loan for $50,000 if they know they're going to get paid back. And then you don't have to worry about the assumption lenders restrictions because it's a private loan. We can help you draft a note that meets all their requirements and doesn't disadvantage anybody. So be open to being creative, be open-minded about it. It's not too difficult, it's not too complicated. It's complicated, it's not too complicated, and we're here to help.
So Todd, we've talked about what the closing process looks like for the buyer. Hurry up and wait, then hurry up. What about for the seller? What does the closing process look like for the seller?
For the seller, it's going to be a little different than your normal closing. And first of all, the seller needs to stay engaged throughout the loan underwriting process, right? I mean, it doesn't happen in a normal process. Usually it's the buyers working with their loan officer and the seller's just kind of waiting. In this case, the seller has to stay engaged throughout. Now, another thing that's different is the fact that the seller will need to sign some of the closing documents and you can't close without them. And in a lot of cases nowadays, our sellers sign 2 days prior to settlement, up to a week prior to settlement. And in the case of a loan assumption, because it is hurry up and then wait and then hurry up again for closing, that seller needs to be available on the date of closing. In our case, like I mentioned, we closed on October 31st, but we didn't receive our package for closing until October 28th, which was 1 business day prior to closing. So we had to get in touch with our seller, courier the documents to them, have them sign in front of a notary. Some of them do need to be notarized, and turn it around in one day. And one thing I can say from doing closings in this area, it's very military based here in Northern Virginia. And I've had sellers in Korea, in India, Japan. And if you're dealing with a VA seller in one of those areas, it's gonna be difficult because you cannot do these loan documents via DocuSign or DocVerify or e-signing. They have to be wet ink signed. And so that's gonna be a bit of a challenge. And it's something that we can handle, we can turn it around, but we do need the seller to kind of be Johnny on the spot when we need them to be to get everything back in time for closing.
So if a seller, let's say, is in India or Korea, because of where they've been stationed, could they do that by power of attorney? Because clearly you can't just FedEx and then have it back the next day. That's not happening.
I'm very glad you asked that question because it's important, and it's something I'm going to be pushing for all of these loan assumptions is that the seller does give power of attorney to someone if they're not in the area immediately upon ratification. In our particular case, our seller did sign via power of attorney, but that was because the seller was having some health issues and was in the hospital. And one thing about that is the power of attorney has to be approved by the assumption lender. And that was another hurdle because at the beginning, that lender didn't approve the power of attorney because it was general in nature and not specific to the property. So what we had to do was step into that void because our seller, unfortunately, didn't have the ability to sign. That particular seller wasn't doing well health-wise. And so we negotiated openly with the lender and we were able to get this general power of attorney approved. And that's how fluid of a process this is. I mean, we have lenders saying no, and then we at the settlement agent level, we're able to say, well, let's talk about this, and we change that no to a yes with that power of attorney. So that power of attorney is a great option. I think it's a must. And it's something that, as soon as any assumption contract's ratified, if you have a seller overseas, I think you got to do it just as a fail-safe.
There's a lot of information out there on the web. And also the Wall Street Journal recently did an article about loan assumptions a few weeks ago. Where is the best place for an agent to go find out about loan assumptions?
Yeah, it's an interesting question, right? Because it's sort of the hot topic. And I know a lot of folks, when they have a question about finance, hey, this is a new form of financing. Who am I going to? I'll talk to my loan officer, my favorite loan officer, my go-to person. That's who I go to. Every time I hear about a new finance, so I talked about buy downs. That's who I talked to about other things. The difference with assumptions, and we talked a little bit about how the closing costs, right, are significantly less in many cases for assumptions. Well, part of the reason for that is because they don't have to pay a commission to anybody, right? You're just stepping into the shoes. It's just a paperwork exercise behind the scenes with the underwriters. But because there's no commission, your go-to person, they're not going to shoot straight, and many of them will just tell you the facts. But just keep in mind that if your source of information is your normal mortgage person or somebody related to them, they're incentivized a little bit to say, hey, wow, assumptions are really, really difficult. They almost never work out, and there's too many catches. And why don't you just do a new loan with us? And so just bear that in mind, right? We're happy to help. We at EKKO Title are happy to help. A settlement attorney, somebody who's been doing this for 20 years, because again, you haven't seen this in a while, right? But we're happy to help and talk to somebody who's been in the business for a while and has worked on these things. Again, not to disparage anybody, but keep in mind what people's potential conflicts of interest might be. We don't really care where the money comes from as long as it's there for closing. And so we're happy to help you. And again, we have some experience, probably as much as anybody who's doing these right now.
All right. Well, thank you very much for watching. As always, if you have questions, please feel free to reach out to any one of us. We'll be more than happy to help. And we look forward to seeing you at our next episode. Have a great day.